So, as I said, we're going to talk about, gold, and in particular, what's the difference between trading and investing. Some of you might be well aware of it. Some of you may not have given it any consideration. Some of you may have been doing both, but not really aware of it. If you know what you think is the difference between trading and investing, just drop it in the chat box there. We appreciate people's insight. We'll talk a little bit about, what do traders and investors need to be aware of, in particular about, when dealing with gold, the precious metal. And we'll talk a little bit about, how can you invest in gold? Okay, is there just the one way, or is there actually a multitude of ways? And hopefully that will give you a little bit of insight, okay, into how you could build it into your own particular way of doing business in financial markets. And we'll also have a little chat about, is gold a good investment? We'll touch upon that as we go through. So, there's some great comments here already. Okay, fantastic. So one of our viewers is saying, after buying gold physically in bullion market, many people open sell position of gold on Forex market MT4 platform. Yes, there is actually ways, and we're going to talk a little bit about the difference between basically, investing in gold and trading in gold, and we'll cover that. Philip says, I've never traded precious metals. Okay, that's great. Thanks for the feedback, because hopefully we'll be able to give you a little bit of insight and education here. And Peter says, I have bought and sold gold in the past, but never traded it. All right. So, there's hopefully this will help you put the sort of kind of pieces of the jigsaw together, Peter. And Phillips is asking, is investing for longer term? Well, all will be revealed, Philip. Good question. Nicely put up there. Okay. All will be revealed. So we'll go through that. And as I say, stay towards the end, and we'll have a little look at sort of kind of the live gold market at the moment to see what we've actually been going on and how that fits into what we've been talking about today. For those who don't know me, my name's Paul. I've traded for many years, and I primarily trade FX indices and commodities, okay, which includes gold. And primarily I like to trade trends for sort of longer term and reversals and mean reversion for short intraday style of trading. And today, Admiral Markets, as you can see here, Admiral Markets are a Forex and CFD broker with, a wide range of financial instruments, with many offices providing global expertise with local support. They are licensed and regulated across a wide range of regulatory environments, and they provide competitive spreads on the most popular trading subjects and instruments, and allows you to engage with markets through trading platforms like MT4 and MT5. And so if you have any questions about Admiral Markets, please get in touch with the account representative. They'll be very happy to help and guide you. But we're going to talk about gold today, and in particular, is gold a good investment? So I'd be interested to know, just on that question alone, of the people here joining us, do you think gold is a good investment at the present moment? It'd be fascinating to see what you think of it in terms of what we've had going on in the world over the last few months. But when we look at gold, right, gold has held a special place in our civilizations since human societies have existed, since the ability to sort of get hold and extract and get hold of gold. And even today, with everything that goes on in terms of the numerous amounts of assets that traders and investors can deal with, gold still holds an allure that few other things can match. All right. And the question for today is gold still a good investment? Is it something worth adding to your particular portfolio? Is it something that you take use from? So in this session, what we're going to do is we're going to discuss differences between trading and investing, because there are, and how you can engage with gold as an investment. So I appreciate some of the people here joining us will be very clear in understanding the difference between trading and investing. Others may not have recognized there is quite a noticeable difference. So hopefully this session will help educate you and sort of just broaden your awareness of what your opportunities and what's available to you. So David says that, yep, he believes gold's a good investment. Excellent, thank you for that. We'll come back to that at the end, okay, and see what people thinks. And Peter says, at the moment, I think the price of gold is so high, I'm not sure it's worth buying at the moment. That's a very valid point, Peter. Clearly, you've been keeping on top of your charts. That's what we like to see here. So we'll hold those two thoughts there, okay? So David said it is a good investment. Peter said he's not so sure at the moment based upon the price. And we'll talk about that a little bit later on, but thank you for that, okay? Thank you for that sort of insight and feedback. So let's talk to sort of set the frame about what is the difference between trading and investing. as I said, some of you might not even have been aware that there is a difference. Some of you might have just been conducting yourself in markets, not really sure, thinking you're trading, but maybe acting as investor. Maybe you think you're investing, but actually your actions and behaviors were like a trader. So, we appreciate that the majority of the time when we are talking on the Trading Spotlight webinar, or when we're talking about any of the kind of collateral and resources that we talk across here at Admiral Markets, we primarily normally usually focus on the trading side, okay? And what we think about that is, as a general rule of thumb, is that trading, what that involves is that, we tend to be focused on shorter time frames, okay? So traders, they might be trading, 1 minute charts or tick charts up to what could be weekly or monthly charts, okay? But the sort of the majority of the focus is on shorter time frames. Also with trading, okay, you generally have the ability to go both long, okay, to be a buyer, and also to be short, to be a seller of that particular instrument. Very often traders are they're looking to generate income. Okay, they're looking to generate income, whether that be a weekly, a monthly, a quarterly, a yearly income. And as a general rule, trading involves a higher frequency of trades. All right, so some traders I work with might trade 20 times a day, others might trade 10 times a month. But as a general rule, it's still trading it's a higher frequency of trades. Whereas on the flip side, okay, investing it tends to be for the longer term. All right, it tends to be, and that longer term could be 6, 12, 10 years, okay, a decade, maybe even 2 decades, okay. It depends upon, your own kind of definition of what that longer term is. But you're certainly not investing, sort of trying to get in and out of a position in a day or a week, okay, or even a month. All right, generally that is trading, okay. Anything over quarterly, okay, anything over sort of, a month to sort of 3 months, we're looking to starting to be longer term and kind of as an investment position. As a general rule, not always, but as a general rule, it also investing is about being long in positions. Okay, you tend to be a buyer. Okay, it's not all the way, but as I said, this is a general rule of thumb for those people who are maybe very new and not really understanding the differentiators between trading and investing. And quite often you'll hear it termed as buy and hold. Okay, you're effectively going to buy that asset, whatever that might be. Okay, there might be a physical asset like actual physical gold, or maybe it's a property, okay, or maybe it's a fund, okay, or maybe it's a particular share in a company, etc. And so you're looking to buy and hold that, and you might, as I said, you might be holding that for 1 year, 2 year, 5, 10, 20. You might be holding it forever, depending upon what you're actually looking at. So yeah, or hodlers for you crypto folks. Okay, I appreciate they have their own little terminology, but because of that, you tend to have a lower frequency in what you're actually looking to engage. So, you're not getting in and out of markets every day. You might not be buying every day. You might actually only be buying, once or twice a month. Okay, you're taking a much longer term focus on what you're actually looking to aim and achieve. So it's very different. Okay, and here's a little bit of free coaching advice for you. Is that very often I see new traders. They take a trade which doesn't go their way that day or over that night, and because they don't want to close the position, they say, oh well, I'll turn it into an investment, hoping that if they hold it long enough that it will come back and actually come into profit for them. Can you do that? Yes, of course you can do that. Should you do that? No, you shouldn't. Okay, what I would say to people is, when you're a trader, you trade, okay, and you have specific rules, okay, that you look to follow, and and demonstrate real discipline in terms of your trading. And investing is, you might be looking at things in a very different mindset, okay, looking with very different view and risk profile over this. Certainly I do myself, okay, and trading, investing, never the twain should meet. Okay, that's a bit of little bit of sort of kind of coaching guidance for you. Okay, when you're a trader, you trade. Okay, when you're an investor, you invest. Okay, it might sound awfully simple, but you'd be surprised how many people forget that. Okay, once they start having their own money engaged in the markets. So not unsurprisingly, they both have pros and cons for both trading and investing. So, the pros for trading are things like liquidity. Okay, it tends to be, as trading tends to be for the most part. Okay, for the most part, certainly for new private traders, you don't generally have issues with liquidity. That means you have the ability to sort of effectively get in and out of your positions quite easily. Your risk exposure is limited. Okay, you might only be in the trade for couple of minutes, an hour, a day, a week, etc. So your risk exposure to the market is much limited. What is possible, okay, and I focus on the word possible, is that you can have higher periods of return as a trader, and that is a possibility, okay, for experienced traders. And also what you have is reduced risk capital. And what I mean by that is because you're sort of in and out of markets, your capital is at risk for a shorter amount of time. In terms of the cons against trading, well, one of the things against it might be that, you have to have infrastructure costs. So what I mean by that is, if you're going to be a trader, especially if you're going to be engaging in intraday trading, you need to have good infrastructure, okay? You need to have good IT, you need to have great internet, you need to have good comms, okay, to be able to manage it. You might have to invest in additional pieces of software, okay, to make sure that you're able to operate effectively. You also have exposure to short-term volatilities, okay, and in the present climate where markets can turn on a sixpence because of they are, let's say, they're rather sensitive to pieces of news coming out because of the geopolitical situation we find ourselves in. That means that you can have exposure to short-term volatilities. There's also with trading is that, you've got fees and commissions. Okay, if you're trading 20 times a day, there are fees and commissions that are going to have to be taken into account. And that is a cost of doing business, which you need to be aware of and you need to factor in. And invariably, depending upon what region in the world you are, there may also be tax implications that you have to be aware of. And that's beyond the remit of our conversation here. But, you would want to get some very good specialist professional advice about your own particular tax implications, if there are any. When it comes to investing, okay, and we're looking at, pros and cons, well, pros for investing are, you've got limited short-term liability, okay, and that just means that you're just, you're not looking to effectively have the sort of to effectively be under the pressure, okay, of being able to deliver in terms of the sort of length and term of your particular positions. Your pros for investing is that you can have unexpected capital gains. Okay, so what I mean by that is it's effectively a case of that you might just be in a position at the right time, and invariably that position, okay, whether it be in a fund or a share, etc., might actually just sort of drive further and faster and higher than you perhaps were expecting. And if you certainly look at, let's say, for example, some of the tech stocks in 2020, you'd be expected to have been happy if you'd bought at the lows there back in March. You'd have had some very nice unexpected capital gains. You also have the ability to compound, okay, and compounding, in terms of just allowing that position to grow, what might be over years, you might want to add to that position that can actually help you. And also your transaction costs are much less, and also you might possibly have less tax liabilities depending upon the environment you find yourself in. And also one of the big ones is time, as in the time required for you to be an investor might only be 1-2 hours a month, okay, just to effectively an hour a month to do your analysis and add buy some positions, and maybe an hour a month just to check and keep on top of your existing portfolio. So in terms of the time it takes is much less. In terms of against investing, well, you've got availability of capital, okay? Once you bought your shares, once you've bought your fund, etc., well, then that capital is tied up, okay? That is not capital that you can employ elsewhere. Generally, you're going to expect to have lower rates of returns than from trading, okay? But that is a general rule of thumb, okay? It will depend upon where you're investing, okay, and your risk profile, which we will touch on later, but as a general rule, you could expect lower rates of return. You also generally have a lack of leverage in investing, okay? That leverage can help you as a trader, but it counts against you as an investor. There is also the kind of market timing, okay? So, it is very possible that you buy an investment and, the market itself just collapses and falls because of what's going on there. And the con against investing is time, okay? In the sense that, on the good side of it was effectively is that, you don't take much time every month to do it. On the flip side, it can take time for your investment to develop and to pay out. And that could be a year, 2 years, 5 years, depending upon your own particular risk profile. So trading, investing, they always have pros and cons, okay? There's no perfection. It's about you trying to work your way through that. So, now we've looked at trading, investing, let's have a look at, well, what is gold's allure? We talked about how it's still coveted, and in the past, as it says, because it was hard to mine, it meant that it was difficult to obtain. And that was one of the reasons it was valued, okay, as well as its, aesthetic qualities. And, over thousands of years, okay, gold was used as a way to acquire wealth, okay, it was used as a way to store wealth, it was used as a way to facilitate trades. And what we found was, a lot of the early currencies were backed by gold themselves. And so for centuries, people have held gold in high regard, and they will covet it, and they'll covet it even to the extent, of making movies about, people's greed and desire to acquire wealth through gold. Okay, you might have seen the James Bond movies. Okay, and a gold thing, but it's it's that hasn't gone away. Okay, that hasn't gone away. Gold is still coveted, and it still has a almost like a kinesthetic quality in terms of the the sight of it, the feel of it, the touch of it. It is almost been evolutionarily wise, sort of in our psyche about the kind of a desire to covet gold in whatever form it may take. So, when it comes to gold, what do traders and investors need to be aware of? Well, we're going to focus on investment today rather than trading. We'll touch a little bit on trading, but the focus is all about investment. What you need to understand is, investors in physical gold include individuals like myself, like yourself, okay, like wealthy individuals. They also include elements, institutions like central banks. Okay, central banks will buy and sell gold. Okay, and very often you will hear traders, investors talk about how central banks can be quite central banks being big buyers and sellers of gold can actually be kind of an inverse signal. Okay, an inverse signal that is of use and of interest to you. And you also have funds, okay, and in particular exchange traded funds who are investing in physical gold on behalf of their particular clients, which we'll touch on in a few slides' time. Also, what we see is gold is also seen as a safe haven investment, all right? And we're not going to go into that too much today, but if you look, we will have a session, I think, in September on safe havens investments specifically. So be sure to keep an eye out that for join us. But what you have to also work out about, when you invest in gold is that gold, unlike a share, okay, or unlike a fund, gold pays no dividend and it pays no interest. So just take that into account. Think about that, okay? So if you're in a market environment where interest rates are high, okay, do you think wealthy individuals, big institutions, would they be looking to buy gold? Would gold be popular to them then when gold pays no dividend, no interest? But what we might be getting is, good interest rates from either investments in stock markets or investment in bonds, okay? Generally, when your interest rates are high like that, well, then actually gold loses some of its allure, loses some of its luster. On the flip side, okay, on the flip side, when interest rates are very, very low, all right, interest rates are very low or even perhaps negative, and then in fact that kind of evens out a little bit in terms of towards gold. Okay, if gold is paying no dividend or interest, but then neither is your bank account, neither is your bonds, okay, well then invariably that kind of evens it up. That adds a different thing because you might get the capital appreciation of a rise in the gold prices. So very often what you find is gold is used as a bit of a hedge against inflation. That's what we see there. Or sometimes it can even be used as a hedge against deflation. Okay, which is depending upon your own particular view of economics, you might say that's an element we're experiencing now. Others might say we're experiencing forms of inflation. Okay, but I think we're not seeing it as much as central banks would like to see it at the moment. But what it is gold actually plays a key pivotal role for wealthy individuals, central banks, and funds based upon where the position is in terms of the overall market economy and also in particular interest rates. So what we want to think about is, well, how do we actually invest in gold? All right, how do we invest in gold? What is actually going on? Okay, what we can look at. So of course, I appreciate that the majority of people who probably join this webinar have, the traders. They've been focused on trading, and they maybe not be aware of all the different ways you can invest in gold. And actually, that there are several. There are several ways we can do that. And actually, we can see here, and we're going to go through them quickly to just have a little look at them. So there's actually ways like jewelry, okay, actually buying physical gold, buying gold certificates, buying gold exchange traded funds, okay? Exchange traded funds which just focus on gold price. There's futures contracts in gold. There's also gold mining stocks, okay? Companies that focus on that. And there are also funds and exchange traded funds, okay, that focus on gold mining companies. So when you start to look at it, there is actually quite a noticeable different ways, okay, that you can engage in gold, some of which might suit you more than others, depending upon your experience, depending upon your capital, depending upon your time, depending upon your own risk profile as well. So why don't we have a little quick look at a few of these, and just to help broaden your awareness and knowledge. So of course, jewelry, all right. And I suppose many people would think, depending upon where they are in the world, that that's kind of it's the easiest way to acquire gold, okay. And certainly in places like India, okay, gold in terms of jewelry, it is seen as a real way to store gold, okay. And very often, it's part of family traditions, okay. That's how jewelry is bought and actually traded within families, and traded because it's easy to acquire. On the downside, well, then it can have a high markup, okay, because invariably, you're buying through normally through a third party, okay. That jewelry has to have been made, okay, so that will have incurred costs as well. So it's easy to acquire, there's also a downside because you might be paying over the odds, and sometimes it can have questionable resale value, okay. Gold jewelry is it's in and out of fashion, okay. So it can be sometimes it might have a questionable resale value depending upon the underlying conditions of the kind of market environment. But as an easy way to begin, or as a standard way, you'll find that is a way that many people look to invest in gold. Then the next way we could look at, as we said, is to look at physical gold, okay. As you can see from the photo, actually buying either little sort of little bars, okay, or sovereigns, okay, or coins, etc. What this allows you to have is you then have direct exposure, and you have tangible ownership. You have a piece of gold in your hand. With that, well, then you have to look at access, okay. The access in terms of what, if any, access do you have to that gold, okay? Is it gold that is basically you buy and you keep under your mattress or pillow? Not that I'm in any way suggesting that as a way to do it, but as a rule to consider how to. You also have to then, once again, it's that cost of markup, okay? You're going to be probably paying more than the actual gold price because there are middlemen involved. And as it says there, all the upside is kind of baked into price. So, it's about, the price. It's about ensuring you buy at a good price. You then may also, depending upon how much you have of it, then you might have to consider storage costs. Okay, you might not want to keep it under your pillow and under your mattress. You might actually want to keep it in a secure facility, okay, whether at a bank or somewhere else, a company that deals with that specifically. And so, of course, that then incurs a cost, which you have to take into consideration in terms of your overall investment. And sometimes it can be difficult to sell. Equally, it can also be difficult to buy. Okay, we're in a strange situation at the moment where actually trying to buy physical gold it has been challenging, okay, because there has been demand. All right, there has been demand, and of course, with the sort of, let's say, the global environment we find ourselves in, being able to ship and store is not easy. So actually buying and selling of it can be fraught at times, depending upon when you're sort of entering an exiting market. But you just have to be aware of that, okay? You just have to be aware of these things as you consider your ways to invest in gold. You could also buy gold certificates, okay, which might be new to people. You might not be aware of it. You might not have heard of it, okay? And once again, it allows you a form of direct exposure, okay? So in this case, you're not getting that physical piece of gold to stick under your mattress, okay? But you are getting a certificate that's showing you that you have you own a piece of gold that's normally a company that is providing that and storing it. So, it takes out the case of you having, there's no need for you to physically own and store the gold. The downside is that it's only as good as the company that backs them. Okay, and this is where an element of due diligence has to be taken into consideration to ensure that you're dealing with a solvent, decent, good company. And there's only a few companies that issue these, and it's largely a liquid. So once again, there might be challenges for you if you wanted to try and sell that on to somebody else. That can sometimes have a particular challenge, but it is suitable for some investors, once again, depending upon your particular requirements and conditions. We also have, one way is to look at is actually futures contracts, which, most traders would consider, about trading a futures contract, but you can actually invest in gold using a futures contract. And it does have, as always, some pros and cons. So, it requires relatively little upfront capital to control a large position in the gold market. So if you felt that, in the summer of 2018, that you thought that, there was going to be difficulties in the environment in the economies, and you want to take a long-term gold position on a futures contract, you would have been able to do that, and it would have required some money to hold that position. The good thing is that it is highly liquid, so you can trade in and out with generally for no real issues. It's providing you indirect gold exposure. So you're owning a contract, okay? You're not actually owning any physical gold. There's nothing for you to stick under your mattress, okay? It's an indirect gold exposure. And, it is highly leveraged, okay? And that will depend upon the regulatory environment you find yourself in. But, you have to remember leverage is a double-edged sword, okay? It's a double-edged sword. It can be enormously beneficial if you have let's just say, if you have the wind in your sails, okay, and you've bought at the right time and prices rallying nicely, well, then, that actually helps you enormously. Equally, it can take the wind right out of your sails, okay, if you're on the wrong side of that market. And the thing is, those contracts are time limited, okay? So, if you buy a physical bit of gold, which you stick under your mattress, well, you could have that to hand on to your kids and grandkids, etc. That's not going to happen with a futures contract, okay? That's going to be a much shorter time window that you're going to be looking to operate in. And then what we said is, you could actually look at gold mining stocks themselves, okay? And the thing is, and I don't consider myself in any way a specialist in gold mining stocks, but generally what tends to happen is that it's an upside from mine development. And what I mean by that is companies they might be looking for something completely else, so, another commodity of some sort, but actually as an upside of it, they might find like a stream, a current of gold in the particular mine that they are looking. Those gold mining stocks, not unsurprisingly, they kind of usually track the gold prices. So, when it's high, they're high. When gold is low or falling, they tend to be low and falling. Once again, it's a form of indirect gold exposure. You're not getting any little gold bars to stick under your mattress, okay? But you do have exposure to what might be rises in gold price if you believe that that's the way it's happening. But on the flip side, you're taking on board the operating risks of running a mine. Okay, it's a dangerous business, but it might also help because you might have exposure to other commodities. So it might be a company that's a mine that's looking for copper, okay, but also actually has it sort of taps into a rich thread of gold as well. So there's a real how would I describe it? Okay, it's a very much, once again, a double-edged sword, okay, and it's something that requires a bit of due diligence, good deal of research, okay, and also just being aware that of the potential downsides as well as just the mere potential upsides. But if you can't do that work, or if you don't feel confident to do the research work on the particular stocks, well, then there are actual funds and exchange traded funds that focus on gold mining itself. So that would allow you the opportunity to have a little bit of diversification. Okay, once again, as we said, it's upside from mine development in general. Once again, they tend to usually track the gold price. That shouldn't really be a shock. It's giving you a bit of indirect gold exposure, but you just have to take on board that, those operating risks of running any mine in the world, okay, for various reasons, and it might be part of a fact that they have exposure to other commodities. But it's, what it allows you to do is it allows, probably the research analysts at the funds or the ETFs, you would hope, okay, are doing specifically good work on researching the actual mines that they, the mining companies that they put into their particular funds. So it's one way for you to get exposure, but without, direct gold exposure, or without actually having to do the full depth research into the gold mining companies yourself. So, hopefully that's helped you. That's just given you maybe a bit of exposure to thinking about all the different ways that, you could actually be an investor in gold. But, brings us to the question of, well, is gold a good investment? Well, this is the how long is a piece of string question, okay? What I do say to people is, when considering this question, we've got to understand one simple thing, okay? And that simple thing is risk profile. You have to be aware of your risk profile. So myself and my colleagues, Marcus and Jens, we can teach you lots of things about trading and investment, okay? There's a whole broad range of topic matters that you see us cover, every week on the Trading Spotlight webinar. But the one thing we can't teach you is you understanding your own risk profile. That has to come from you, ladies and gentlemen, okay? And there will be people watching this here in the room today. There will be people watching this later, okay? Whether it be in a week, in a year, in a decade, okay? And it's about understanding, where your risk profile sits, okay? There'll be some people who are very risk accepting, almost, quite aggressive in their dealings with risk. Other people who are very cautious, okay? They're very risk averse. And we all sit on that spectrum, okay? We all sit on that spectrum. And the best advice I can give you is to find where you sit on that spectrum, okay? And to work with yourself, okay? If you're a very risk averse person, okay, who is very cautious, well then engaging in a trading or an investment plan that is very aggressive or very requires a huge acceptance of risk is probably unlikely to work for you, because you're not going to be comfortable, okay? Your emotions will be triggered, you'll make impulsive decisions, you'll make poor decisions, you make knee-jerk decisions, and it rarely works out well, okay? So you need to know, where do you sit on that risk profile when it comes to particularly investing and investing in gold, okay? And how much risk you are comfortable with, okay? And what you find is that what I find is dealing with, I've dealt with thousands of traders, investors over the years, is that people tend to say that they are very, very accepting of risk. They say that they have, they're very tolerant to risk. The reality is people aren't as tolerant as risk as you think they are, okay? They're not. What they say and what they do can be very different, okay? And what I'm saying is, you just need to understand who you are, okay? And there's no right or wrong, okay? There's no right or wrong in terms of you being on the, being very aggressive or being very cautious. There's no right or wrong. It's about what works for you. What are you comfortable with? And, you can find that out by just keeping good records of your trades and investments, and making sure that you keep good records and that you debrief, okay, yourself. And you will find by doing that, you will start to get a good handle on what your risk tolerance is, okay? You'll have to work out and understand, what that is. And we're going to have a look at the gold chart in a moment, so stay with us, and we'll have a look at the gold chart, because once again, it's a fascinating chart at the moment, and it will allow people to have a discussion and debate and a consideration about, is gold a good investment for you? Okay, is gold a good investment for you based upon your risk profile? And we'll look at that in a moment. So, ladies and gentlemen, before we switch across to the charts, okay, let's just quickly recap on some of the conclusions of the many things we've just covered over the last session. There is a difference between being an investor and being a trader, okay, and it's important for you to know the differences and to know when you're being one or t'other. It is important to understand those differences, okay? Don't let trades become investments, all right? There's a bit of free guidance, okay? Free coaching guidance for you there. But when we look at gold has been coveted for years, okay? For thousands of years, and that is unlikely to change, okay? We might have crypto, okay, etc. here, but the reality is human beings, there's still a kinesthetic love, desire for gold. We covet it. hopefully what you've seen today is that there are, in fact, many ways to invest in gold. Some of you may have thought them, some of you may not have realized, some of them might be completely new to you, okay? And it is, about recognizing that as well as the physical element, okay, in terms of trying to buy gold coins or gold bars, you could also look at things like gold mining companies or funds that look at gold mining companies. But the important thing is, you need to understand your own risk profile, ladies and gentlemen, right? That's key and that's paramount when you come to talking about investments, okay? Is it, you need to know whether you're enormously cautious, okay, and not very tolerant of risk, as opposed to very accepting of risk, perhaps even aggressive. We all sit on that spectrum, okay? We all do, all right? And it might be different. It might be different for different asset classes, different styles, okay? It might be different. But when it comes to looking at gold, okay, you have to think about that risk profile and the timelines that you are considering. So why don't we check it out on Live Market? Let's have a little look, okay? And that might spark a little bit of a consideration and debate here when we look at the particular charts. So as always, if you want more insight, if you want more support, okay, and what traders don't love a bit of extra support, well, you can get support by joining the Trading Spotlight community on Traders Yard, where you'll see myself. I'll be in there for the rest of the afternoon. I'm in there, pop in there during the weeks. And also what you'll find is my colleagues, Marcus and Jens, okay, they're putting up great stuff, day in, day out, some really fascinating pieces of information, education, and insight that they provide. And they'll also have any of the recordings that you might have missed. So you can see that there, tradersyard.com/group/312. And as you can also see that my wonderful assistant has just put a link there in the chat box there. So please, by all means, come and join us, okay? And you'd be very, very welcome to join us. And as always, don't be surprised or don't be afraid to join my colleague Marcus on Wednesday. He's going to be talking about the risk and rewards of hedging. And he'll talk about what is hedging, what's the real meaning of risk and reward in your chosen strategy. So that will be kind of an interesting, useful webinar after what we've discussed today in terms of understanding risk profile. That's at 2 o'clock on Wednesday, 12th of August, and the link will be in your webinar. The link will be in your email, or you can find that on the admiralmarkets.com website there. As always, if you want to contact us, you can email us at global@admiralmarkets.com. Have a look at this on youtube.com/admiralmarkets. As I said, all the Trading Spotlight webinars are on there. If you like it, give us a link, okay? Just give us a like there. It's great. If you've got questions, put them in there. We're always fascinated to see them. And also on facebook.com/admiralmarketsglobal. So I hope you found that useful. I hope it's given you just a little bit of food for thought, a little bit of insight, something to think about in terms of the ways you can look at and invest in gold. And if you'll bear with me a moment, what we'll do is we'll just switch across to the Admiral Markets MT4 platform, and that way we can have just a quick look. We've got just a couple of minutes. We can have a quick look at the gold chart. Everybody likes a look at a chart, don't they? That's the long and the short of it. Okay, so just hopefully this will come up here. Hopefully you can still see still hear me and see me, and hopefully you can still see the chart here. So I have in my MT4 platform, I have a profile set up for commodities. If you want to know more about how to get the best out of MT4, there are quite a few videos in the Trading Spotlight webinar archive. You'll find that on the YouTube channel, okay? They give you some great help and advice and hints and tips on how to get the best out of MT4 and MT5. But let's have a look at the gold chart here. And yeah, this is the gold daily chart, ladies and gentlemen. So for those of you who are completely new to trading, joining us for the first time, my charts are normally very, very simple. Okay, green bullish candles, red bearish candles. I have a blue 20 period moving average, a red 50 period moving average, a green 200 period moving average, and some fractals on there, and just drawing in significant levels of lines of support and resistance to allow me to just have a quite sort of clear picture there. So as I said, this is the daily chart, and you can see for yourself. Here we go. We can actually see that. I'm going to just draw this in here. Over the the last month or so, we've had a little bit of a tear away, okay, in gold. We had this just here we go. We had just a couple of week, okay, kind of a couple of 10 days, trading activity in a nice little rectangle there, just around about the $1,800 mark. And then from that, once we broke out, you can see that Bosch, we've rallied our way up there. Okay. And we actually had, we had a bit of a bearish engulfing candle there on Friday, which is not really a surprise, because once markets start going, accelerating up, well then, there's always going to be somebody who wants to take some profit. And, we can see that, on Friday, we traded as high as 2074 dollars an ounce. Okay. And this is where we look at the bigger picture when it comes to basically is gold a good investment? Because when we look at the monthly chart, well, we can see it. I'm just going to zoom out here, hopefully, just 1 second. What we can see is that actually gold is really trading its way there. It's it's kind of all-time highs there at this moment, and it's been quite a run. And I kind of hinted at sort of earlier in our session that if you had been considering being a buyer around about the summer of 2018, when gold was hovering around about the 1200, okay, well then of course you've done very, very well. And what we've seen is here we go. Is that, excuse me, over the last sort of 2 years, gold has actually just dragged its way, and that has accelerated. So personally for me, if you're looking at it now, remember what I said earlier, it's about risk profile and an element of timeline. How long are you considering to hold? You remember, investing is different from trading. Okay, investing, you're looking to hold for a long time. So some people will look at that and say, gold has been going up, I want to invest in it, okay, and will want to be a purchaser. Other people might say, well, actually, we've already had quite a run, and then I would be wary of investing in gold at the moment, because it's actually just been going almost vertical. And think of it like gravity, okay, nothing really escapes, very little escapes gravity. Okay, once something goes straight up, it tends to come straight down again. But once again, as I said, it's all about risk profile and timeline. And the thing is, if we look at here on a longer time frame, let me just move these out of the way here. If I look at this on a much longer time frame, well then there'll be some people here looking at this sort of saying, well, do you know what, actually, Paul, I'm a very long term, I might buy gold for 20 years. And they might be looking at saying, well, this is kind of a much bigger, what they call ABCD pattern here that's going on, that actually is just, that's what we've been trading through, a sort of a real big move up, pull back, and then we've got another long big move coming up, which will carry on. And so there's lots of people who will be looking at that saying, well, actually, gold still has a much further way to go in its move north. So, as I say, it's about your own risk profile. It comes about understanding your timeline, and about recognizing, what kind of your risk reward that you are able to tolerate. So there you go, ladies and gentlemen. Unfortunately, we've run out of time as always. But as always, I hope you found that useful and interesting. I hope it's given just a little bit of insight and a bit of education. And as always, I wish you the best of luck with your own trading and investing endeavors. And I look forward to seeing you next Monday. And I'm sure you'll enjoy my my colleagues' Marcus and Jens sessions for the rest of the week. So take care and trade and invest well, everybody. Thanks very much.